In this video, I want to talk about Amazon, which is another NASDAQ stock. The NASDAQ has been really strong. In my last video, I placed a trade on Apple stock using stock options. And in this video, I want to talk about Amazon. I want to talk you through a setup that I commonly use for when I'm expecting a very quick pop up in the stock to try and take advantage of a stock moving to the upside. Now, I've got a stock chart here of Amazon. As I've said, I've drawn a trend line to the upside. You can see that the stock's moving up fairly aggressively, and this yellow bar here is a 50-day moving average, and I'll talk about why I've put that in place as well. It's an indicator that's available on practically any stock charting platform. Now, the stock closed at 775.1. okay, so I'm looking at the top here. There's the date, the open, high, low, and close. So if I put my mouse on the particular trading day I'm interested in, now this is a close from the 19th of September, okay, so the last trading day, and on this particular day the stock closed at 775.1. Now all I'm looking at Amazon doing is just continuing its trend and moving to the upside. I'm expecting it to move up above its most recent high. So on this particular trading day, the high of the day was 781.94, and I'm expecting the stock to continue and close above its previous day's high, which is the current trading day. Okay, and so somewhere between 780 to 790 is all I want the stock to actually to do. Now obviously I could be wrong. The stock could completely tank and move back down to the downside, as I've said in other videos. There's no guarantees in trading. The stock can do whatever it wants to do. Nobody knows what the stock's going to do next. Okay, so in this particular case, I'm simply expecting the stock, my prognosis is that the stock will continue its trend to the upside and move up towards the 780 or the 790 area. Now this vertical black line is my timeline. Okay, so I'm only going to be in this trade for the next couple of days. I'm using weekly options. These options here expire on the 23rd of September, which is this coming Friday. Okay, so I'm just going to be in this trade for the next couple of days, and I'm going to construct a trade. It's going to be an interesting trade. I'm going to walk you through it in a moment, where all the stock needs to do is to stay above a certain level. So it's a non-directional trade. It's a specific type of trade that I'm going to construct. I'm going to walk you through, and it's a really, really cool trade because all the stock needs to do is stay above a certain level for me to achieve my return on investment. So for example, the way that I've constructed this trade, all the stock needs to do in one of the scenarios I'm going to walk you through is stay above the low of the last trading day, which is 771. Okay, so look at the numbers up here. This is where the high, low, and close is detailed for when I move my mouse over a particular trading day. So all I want the stock to do to succeed in my trade is to stay above the low of the most recent trading day, okay, which was on the 19th of September. Okay, so yesterday's trading day. And that's pretty cool because the stock may continue to go sideways or may continue to go higher, and all I need for the stock to do is to stay above this line, which is around the low of the last trading day, for me to achieve the expected return on investment, which I'm going to walk you through. Now I've got a couple of these. I've got 3 or 4 of these that I want to walk you through because I looked at a couple and then I chose a particular one that I liked, which was in line with my risk tolerance and in line with my prognosis. Okay, so the first one I'm going to walk you through is I looked at basically selling a put option. Okay, I looked at selling an at-the-money put option. Okay, so the stock at the moment is trading at about 775. So the at-the-money call or the at-the-money put option is going to be any option with a strike price of 775. So in my case, I've sold a 775 put for $625. So I've taken in to my trading account $625, and to protect myself, I've bought a 772.5 put, and I've had to spend from the 625 that I took in $520. Now, what this actually does, it creates a credit spread. Okay, so I don't want to go into too much detail about what a credit spread is, but essentially it's when you're receiving an income by selling an option and you're buying a put to protect yourself for a much lower price. So in this case, I've sold a option which is valued at $625, and I've bought an option which is valued at $520. Now, the reason that I need to buy an option is so that I don't have unlimited risk. Okay, now you need to think this through in your head. When you buy a call option, you're essentially long the market, meaning you're expecting the market to rise and you're potentially going to profit as the stock price rises. Okay, when you buy a put, you're expecting the market to drop and you're going to potentially profit as the market drops. Okay, generally that's how options work. Now, in my case, I've done the opposite. Okay, if when you buy a put, you're expecting the market to go down, well, when you sell a put, you're expecting the opposite. Okay, if you sell a put, you're expecting the market to go up. Okay, it's the opposite of buying a put. So that's what this means. I've sold a put, so I've sold a put on Amazon, I've sold a put, and therefore I'm expecting Amazon to rise. Okay, now which put have I sold? Well, you can see here it's a 775 put. Okay, so I'm expecting that the price of Amazon needs to be above 775. Okay, and 775, if I mark that here with a line on the chart, is going to be at around about, let's just get this right, 775. So this is the put option that I've sold. Let me also mark this in a different color. I'll mark it in purple and I'll make it a little bit thicker so you can see. So I've sold a 775 put. Now you can see that's right at where the market closed on this particular trading day, the last trading day. Now that is, the market can go a little bit lower, right? And I'll still make a profit, or go higher and I'll still make a profit, or not move at all and I'll still make a profit. That's why I like this type of trade. Now, because I've taken in $625, my actual break-even point is 773.94. Okay, let's just say 774. It's actually written down here. It's 774 because I've taken in a credit. Okay, and I haven't received all of this $625 as credit because I've had to buy a put option in case the market comes down hard. At least I have another put option that I can use to limit my loss. Okay, you can see that by buying this put option, let's put that here on the chart as well. It's the 772.5 put option, 772.5 put option. Let me mark that here as well. This is a slightly advanced strategy. I don't recommend any new traders to put in place this strategy because you do need to manage this trade and it's very short term. Okay, so you need to know what you're doing to be able to play this type of trade. Okay, so you can see it's pretty close. Okay, so I've bought the 772.5 strike put option and I've sold the 775 strike put option. Now, the reason that I've bought an option just underneath the one I've sold is, well, if I didn't have that and I've sold a put option, which means I'm giving somebody the right to sell their Amazon shares at 775. Well, if Amazon all of a sudden tanks to below 740, I'm going to take a $50 loss per share, right? Remember, each options contract has 100 shares. That's how much an options contract controls. And in my case, I think I did 10 contracts. You can see the number of contracts is 10. So my exposure is 1,000 shares. And if Amazon shares tanked all the way down, then my potential loss is more than $50,000. Okay. So that's why I need to have in place a put option that I can use to protect myself in case the market goes against me. At least I have some sort of protection. Okay. If I'm giving somebody the right to sell their shares at $775, well, that means I have to buy them at $775. Okay. So if we look at that scenario, if I've given somebody, by selling a put option, I've given somebody the right to sell their shares to me at $775, if all of a sudden Amazon shares are trading at $740, this is just an example so that you can understand the risk here. If all of a sudden Amazon shares are trading at $740, well, the person that bought his $775 put from me is going to exercise their option, forcing me to buy their Amazon shares at $775, where at that point in time, Amazon shares might be trading at $740. Okay, so if I've got this 772.5 put, then at least I can turn around and sell those Amazon shares that I've now purchased for $775 for $772.50. Okay, and therefore I'm going to limit my loss, even though Amazon shares at the time might be down at $740. Okay, so that's why I have to buy a put option to limit my loss in case the market doesn't do what I'm expecting it to do. Now, of course, what am I expecting it to? Well, I'm expecting that the market is going to go above 775 into 780 or 790, in which case this put option that I've sold will be worthless. Okay, it's going to be worthless because who's going to exercise this put option that's going to allow them to sell their shares at 775 when the market price of those shares is above 775? For example, let's say Amazon does hit what I'm expecting it to do, which is to be above 780, somewhere between 780 and 790. Let's say Amazon shares do in fact move up and they move up to 785. Well, why would somebody exercise the option that they've purchased, which is the put option that I'm selling, which allows them the right to sell those Amazon shares at 775 when right now they can sell those same shares in the market for 785, right? It doesn't make sense. Okay, so that's also why that particular put option that I'm selling today for $625 will be worthless. Okay, it will have no intrinsic value because it's going to be out of the money at that point in time, far out of the money, because it's very far away from where the current price of the stock will be in that future date. Okay, so hopefully that sort of gives you some reasoning around why I need to buy a put option if I'm also selling a put option, and why and how that protects me. Okay, so let me talk a little bit more about how much the stock can actually move down before I'm going to start to get a bit nervous. Now, because I've taken in a credit, okay, the difference between what I've sold this option for and what I've bought the protective put for, that difference is, in my case, $105 because I'm buying 10 contracts. The total credit I'm receiving is $1,050. Now, the maximum risk, the maximum amount that I can lose in this trade is $1,450. Okay, so now that's basically worked out by the difference in the strike prices. So 775 minus 772.5 is 2.5. Okay, so it's $250 per contract is the potential loss. If I'm doing 10 contracts, it's $2,500. Okay, now then you take away the credit that I'm receiving, and the maximum loss is going to be $1,450. Okay, now that will occur if the stock closes below this 772.5. So the stock right now, remember, is at 775. Okay, so my break-even point is 773.95. Okay, because I've taken in this credit, the stock can go lower than the put that I've actually sold. Okay, before I'll start to actually lose money. So let's mark this on the chart as well. Let's just call it 774. That's basically my break-even point. Okay, the stock can actually move down to 774 and I will still be okay and not lose, because that's going to be my break-even point. So 774 is going to be my break-even point because I've taken in a credit for this particular transaction. Okay, now what that means, so I'll get rid of this line here, that's not relevant anymore. What that means is, if you look at this trade closely, so the black line here is where my break-even point is. So stock right now is at 775, which is right there. Okay, so in this scenario, the stock can go down a little, okay, and I'll still be okay in this trade, or stay at its current level, that's 775, and I'll still be okay, or skyrocket to whatever level and I'll still be okay. Okay, so in this particular trade, I can win out of the 3 different potential movements in the underlying stock. The only time I'm going to be a little bit worried if the stock starts to creep lower and starts to go below this break-even point of 774. Okay, now if we look at this a little bit closer, let's look at the risk graph, which is down the bottom. You can see that the current stock is indicated with this blue line here, which is 775. Okay, if the stock continues to rise, I'll make a profit. That profit is capped. Okay, you can see this line here at expiry. That profit doesn't get any bigger. Okay, and that profit is capped at the credit that I've received, which is $1,050. Okay, now you can also see if the stock starts to move down, then I'll basically start to lose more and more money. Obviously, I won't lose any more than my maximum risk. You can see it's capped at expiry. My maximum risk is this mark here, which is at 1450, as I've said. Okay, indicated here. Okay, which is the difference in the 2 strike prices, which is $2.50. minus the credit I've received, which is $1.05. Okay, and because I'm doing 10 contracts, it works out to be $1,000.50, and the maximum risk to be $14.50. Okay, and so you need to pick, if this is the particular position that I am going to do, that I need to pick a point on the chart where I'm going to say, look, that I want to sort of cut my losses. I'm not going to hold this trade and just watch the losses increase if the stock starts to move down. I'm not going to hold this trade and wait to receive maximum loss of $1,450 if the stock turns around and starts to go down. So I need to think about where on the chart am I going to say to myself, this trade is not going to work out, cut your losses and look at the next opportunity. Well, if I'm looking at this particular position, then I don't want to be in this trade lower than, if the stock moves lower than the last trading day's low, which is around that 770. Okay, so if we go back to the stock chart, the low of the day is 771. Okay, so I don't want the stock to be lower than 770. If the stock starts to trade below the low of the last trading day, then I want to exit this trade. And I can work out from my risk graph how much potential loss I would incur. So the potential loss that I would incur, depending on how long or how fast the stock moves to 770, sorry, the loss I'm going to incur is around $450, okay, which is in line with my risk tolerance. Normally, for these types of positions, for when I'm doing these types of credit spreads, I'm willing to give up 50% of my credit at a stop loss level. Okay, so I can see that 50% stop loss is going to occur. So that $500 stop, that $500 loss is going to occur somewhere around when the stock is around 770, which is in line with what I was thinking, which is that if the stock goes below the last trading day's low of the day, then I want to exit this position, because then my prognosis is wrong, which is that the stock's either going to move up or trade sideways for the next couple of days. Okay, so that's the first one that I looked at, and that's basically selling a at the money put option, which is a 775 put option with a protective put, okay, with the purchase of a protective put at 772.50 for a total credit of $1,050 and having a maximum risk of $1,450. Now that's pretty, I mean, if you look at the numbers, it's a 72.41% return on investment in just 4 days. These options that I'm using expire on the 23rd of September. Okay, so it's only a 4-day trade, so that's not bad. I mean, that's not bad ROI, right? If you put your money in the bank, you're only going to get 8 or 10% return on investment for the whole year. We're talking about just 4 days' time. Okay, not bad at all. Now, what I like to do is I like to then look at, you know, a couple of more, because I want to see if I can move this break-even point a little bit lower. You know, can I get a break-even point below maybe this 770, for example? Okay, because that gives me a little bit more room for the stock to move around. So I like to see, look, right now this is a bit too tight perhaps. Okay, I'm willing to take in less credit and less ROI in 4 days, okay, to give myself a much better probability of success. Now, how can I improve my probability of success? Well, I can construct a trade where this break-even point is perhaps at 770, okay, because that means the stock can move a little bit more to the downside before I start to worry. So I'm going to show you the next one that I looked at. And that is basically I then sold the 772 put, okay. I took in $522 for that, and I bought as a protective put the 770 put, okay. Let's mark those numbers on the chart. So I've sold the 772.50, okay. So the one I've sold changes to 772.50, okay. 772.5 is the one that I've sold, and the protective put, whoops, what have I done with that? Okay, I don't know what I've done there. Just draw that again. You guys probably saw what I typed in. I'll probably see what I typed in when I look at this video once I've finished producing it. So 772.50. I don't even remember what color I chose, but that's okay. I'll just stick with this, make it a bit darker. So that's the one I've sold, and the one that I've bought I think is on that number as well. So I'll just, it was the, let me double check, what's the one that I've bought? 770 is the protective put that I've bought, so 770. Okay, so you can see it's a bit wider. It's a, well, it's the same width, it's still 2.5. Now let's see what is the break even. That's 771.63 to break even. Okay, so let's move this line down as well. 771.63. Okay, so you can see the break even now is a bit more closer to the low of that particular trading day. So I've got more room. Here's where the current price is. It's marked by that little point that's sticking out to the right of this bar chart. Okay, so you can see that means I've got a bit more room for the stock to move around and even all come down to this level of 771.63 before I really start to worry. Okay, now if we look at the risk graph on this particular one, I'm taking in $870 of credit. I'm now risking a little bit more, okay, because the width is still 2.5. I'm selling a 772.5 and I'm buying a 770 put, so the width is still 2.5, and because I'm receiving a less credit, my risk, instead of $1,450, is now 1630, okay? Because the risk is calculated by taking the difference between the strikes, okay, and taking into consideration the credit to work out your risk, okay? Now, if we look at the risk graph in this particular case, you can see that, remember what I said, that my potential loss that I'm willing to take on this trade is 50% of my entries. So somewhere around about 435 is what I'll accept as a loss. So where does that occur on the chart? So if the stock starts to move down, where will I lose? Around about $435, okay, is what we need to work out. Now you can see that's going to be somewhere under 770 in this case. So let's just say it's there. So if the stock goes down to 769.63, I'm going to lose about $420, okay? Now that's pretty cool. I don't mind that, because I'm now allowing the stock to move just below yesterday's close as my risk level, and giving it some room to move around before I really start to worry. So I will need to close this trade if the stock starts to trade below 770, okay? If the stock, as you can see, doesn't move, if it just sort of stays where it is now, which is up here, 775, okay, then I'm going to be able to keep the premium that I've collected, which is $870. Of course, if the stock rises and moves up, then I'm able to keep the premium. So you can see, here's the current price of the stock. It's marked, it's indicated on this chart by this blue line, okay? This blue line represents the current price of the stock, which is 775. So if the stock stays at its current price at options expiry, my profit is going to be here, okay, which is at $870, which is the credit that I've taken. Okay, so if the stock doesn't move, I'll make $870. If the stock moves up, I'll make $870. Even if the stock goes down a little, okay, you can see, even if it goes down a little below its current level, I'll still make $870. Okay, the stock can go down to 771.63 at options expiry. Okay, and that's my break-even point. At that point, I'll basically be zero. Okay, so I don't mind this trade. It gives me a bit more room than the previous trade to be right. Now, the next one I also looked at was a put option where I sold the 760 put. Now, the reason I constructed this particular trade is because if you look at this yellow line, that's the 50-day moving average, the next big support level. It's also right at where the trend line is for this particular stock. So I've spoken about support and resistance in the past, but basically that level there where the trend line is also right around that level, and the 50-day moving average is also right around that level, that is a fairly major support level. Not only that, but the stock has had some heavy support at around that level as well. Okay, this whole section here is clearly an area where there's a fair amount of bouncing around in the stock. So it's a fairly strong support level. So I thought to myself, well, what about if I sold a 760 put? Out of all these three, selling the 760 put is the most high probability, right? It offers a less return on investment, only 17.37% return on investment. Still pretty good for 4 days, right? But it has a much higher risk because we're receiving a much lower credit. The more higher the probability of success, the less credit you receive. Okay, that's just how it works. And the reason for that is because we're selling put options that are very far out of the money. They're much, I mean, the current price of the stock, 775, you know, we're selling a 760 put, which is all the way down here. So its value is going to be much lower than a put option, an option that gives you the right to sell closer to where the current price of the stock is, or even, if you know, even higher than where the current price of the stock is. Okay. So I'll just draw those numbers on the chart. So 760 put, let's put that. I'll get rid of this line because we don't need it. The 760 put is the one that we've sold in this scenario. And then I'll talk to you about the one that I actually went with. Okay, now the one that I've purchased as protection is the 757.5. 757.5 is protective put. As I said, this is a much more advanced strategy. Not one that I would recommend you get into until you are very comfortable with trading options. And the break even is 759.63. 759.63. Now you can see that that is a much better looking scenario, because now the stock has a lot of room to move. I mean, now the stock can go all the way down at its 50-day moving average before there's really any issue with this stock. Now remember, we've only got 4 days. We only have to be in this trade for 4 days, okay? So that's the most highest probability trade out of these three that we've analyzed. But of course, that's the highest risk and the one with the least reward, okay? Now, it's still a pretty good return. I mean, nearly 80% return on investment in just 4 days. A very high probability trade. Pretty unlikely that the stock's going to go all the way down below its 50-day moving average and below and break this trend just in the next couple of days. Very, very unlikely. Of course, it's possible. Okay, it's definitely possible, and that's why we have to have a protective put to protect ourselves. So that's why our risk is limited. Okay, but if we follow our rules, where would we receive a 50% loss of this credit? Okay, so if we take this credit, we need to work out where would we have a potential loss of $185. Well, if we go down, where we're going to lose roughly that $185, it's going to be somewhere around looks like around about 765. Okay, so around about that 765. Okay, now it depends when that occurs, because a lot of value is squeezed out of these options as it gets closer to options expiry. So you can see in the last day of trading, this black line between this green line and this black line, there's a big decay in those options, and that's what's allowing us to potentially hold this trade even if the stock goes down to 760 and even lower. Okay, potentially lower. All right, so it all depends on what you are comfortable with as a trader. Some people might be much more comfortable with this setup where there's a lot of room for the stock to move around before the trade is under any pressure, okay? But then others might not like this small reward and high risk. And what you're doing there is, if you are increasing your reward and thereby reducing your risk, you're basically reducing the probability of that trade, okay? That's what you're giving up. So if we look at the one we looked at before, we're increasing the reward, reducing the risk, increasing the return on investment, okay? We're now going from that 17.37 return on investment in 4 days to a massive 53.37% return on investment in 4 days. But we're now reducing the probability of success because our downside break even at expiry is much higher. Okay, our downside break even in this previous position where the credit was only 370 was under 760. Okay, it was at 759.63, which is right at that 50-day moving average. It's also at the trendline support and at a level where there's been previous support, so a fairly strong support level, meaning it's a fairly high probability trade. Okay, but it's a small return on investment, maybe not so small based on simply a 4-day trade. Okay, but this one, the numbers are better, but the probability of success is lower because the stock cannot move much lower than where it is right now. In fact, it can't move more than 5 points. It's at 775. It can't move lower than 770. Okay, so as a trader, you need to, analyze your own risks. Every trader has their own risk tolerance levels. Okay, each one of these positions is as good as the other, but it all depends on your own risk tolerance level and what you're comfortable with. And then we also looked at this one, which had a much higher credit, but then the stock can't move much at all. The downside break even in this one is 773.94, only $1 away from where the stock is right now. The stock's at 775. Okay, so no room at all for the stock to move. So even if the stock just goes down a little bit, you're in trouble. Okay, although you can manage this trade, if a little bit of time go past, you can say, well, I'm willing to risk $500, which is 50% of the entry, and I'm willing to hold on to this trade until the stock goes below that 770, which is the previous day's low. Okay, that's again dependent upon how you want to manage the trade as a trader. What's your management plan? Some traders might be happy with that, to go with this to potentially receive a higher credit and manage the trade such that they're willing to let the trade move down to 770 and risk a potential loss of $500. Okay. Now, for me, I'm probably a little bit comfortable with this setup where I've given the stock a little bit more room to move because I've sold a slightly out of the money put option, the 772.50. I've received a lower credit for that. My risk is greater. A great return on investment if I'm right in just 4 days. Okay. And I'm okay to let the stock move even lower and risk around about $430, which is going to happen somewhere around about that 770 as well. Okay. Now you might say to yourself, well, if you're willing to let the stock move down to 770, then why not take this trade, taking a $1,000 potential reward, keep the same management plan, let the stock move down to 770 and take a loss of 500 instead of a loss of 435, which was the 50% of this credit, which is 870. Because if you work out where is the 50% potential loss based on a credit of 870, which is 435, then the chart tells us we're going to potentially lose 435 when the stock is just under 770, which is very close to the level that's on the other position as a stop loss level, but you're then risking more. Okay, so again, it comes down to your own risk tolerance levels and what your own prognosis is. Your prognosis for this may be the stock's not going to continue to the upside. The stock's going to come down. Well, if that's your prognosis, you wouldn't be selling a put spread. Okay, we only sell a put spread when we are of the opinion that the stock's either going to continue rising or the stock's going to go sideways. If you're of the opinion that the stock's going to come crashing down, well, then you're not going to be selling a put spread. Okay, because that would not be in line with your prognosis. So my prognosis based on my own analysis is that the stock's going to either move sideways or continue higher. Okay, of course it could be wrong, and I've discussed how I'm going to manage the trade. I'm willing to risk a maximum of $1,630, and I'm going to try and manage the trade such that if the stock goes below 770, sorry, I'm going to basically look to close the trade and take a potential loss of around $435. For those who may prefer this particular trade, they might manage this differently. They will take in a credit of $1,050 and they're willing to risk a maximum of $1,450, and they may manage a trade such that if it goes just below 770, which is the low of the previous trading day, then they're willing to potentially lose up to around $500. Now, you may have a different management plan in place. You might be comfortable holding this position until you achieve maximum loss. That's not my trading style. That's not my management plan. But that's perfectly fine if that's in line with your own risk tolerance. So you might just put the trade on and say, hey, I don't care. Either the trade works or it doesn't. If it goes sideways to or slightly higher, I'm fine. If it doesn't, I'm going to hold on to that trade until I lose this maximum risk, which would occur if the stock goes below 773.95, okay, which is your break-even point on the stock chart. So they're the three positions that I wanted to talk to you about. A slightly different approach to play the market to the upside. Remember, we're playing Amazon to the upside. We're expecting it to move up or slightly move to a sideways direction. So it is a bullish play, but it's non-directional. We're not looking for a specific target. Amazon does not have to reach a target level for us to make a profit, and that's the beauty of this type of position. So long as Amazon stays above our break even, which in this particular case is 773.95 at options expiry, then we're in it for a profit. So I hope it helps, and I'll post up an update to this particular video at the end of this trade, which is in the next couple of days. And then I'll let you know how the trade worked out. Remember, you always need to know your risk. You always need to manage your risk accordingly. This particular strategy is slightly advanced. I would not recommend anyone who doesn't have a good understanding of how options work to even try this particular position. Always trade with capital that you can afford to lose. Okay, know your risk, manage your risk, and know that options trading is very risky. Okay, hope it's been helpful. All the very best.